Hey and welcome back to my channel. Today I'm going to tackle the subject of the individual savings account, or the ISA, and the different flavours of this product that are available in the UK, and which one I think you definitely need to have. Before we get started though, please remember to subscribe to the channel, and if you get any value from this content, make sure you hit the like button to help this information reach more people. So before we get started, I want to point out that I'm not a financial advisor and nothing in this video is financial advice. It's solely for information purposes, and I urge you to do as much of your own research as you can when you finish this video. But not before you hit subscribe. Have you subscribed yet? Great. Let's get going. So I think the best place to start on this subject is a brief history of the ISA. So the individual savings account was introduced in the UK in 1999 by Prime Minister Gordon Brown, replacing similar products called PEP, or Personal Equity Plans, which are the equivalent to a stocks and shares ISA now, and TESAs, a tax-exempt special savings account that you would now compare to a cash ISA. The initial yearly allowance for an ISA was £7,000. Over the years, the annual allowance has increased incrementally, and at the same time, old products were merging into ISAs due to their tax efficiency. The child trust funds evolved and rolled into the junior ISA in 2011. So over the coming years, policy continued to change, and the percentage you could split between a cash ISA and a stocks and shares ISA kept moving. By March 2014, a maximum of 50% of all money held in your ISA could be in a cash ISA, with the other half being allowed to be put into a stocks and shares ISA. And in the same year, you were able to transfer money from a cash ISA to a stocks and shares ISA, and vice versa. 2014 was a good year for ISAs. George Osborne also announced that widows and widowers would now be able to inherit ISAs tax-free. Well, up until this point, ISAs lost their tax-free status upon death. So any money inherited from an ISA would not be counted towards your ISA allowance. So 2015 saw further flexibility added to the ISA, whereby you could take money in and out of the account freely, and the Help to Buy ISA was introduced. And this really helped people save for their first homes. And also added to the ISA portfolio this year was the innovative Finance ISA. Now this ISA allowed investors to engage in peer-to-peer lending with the usual benefits of an ISA. So in 2017, the Lifetime ISA, or the LISA, was introduced to help both first-time buyers as well as help you save for retirement. And the introduction of the LISA subsequently caused the death of the Help to Buy ISA. So an ISA is what's known as a tax wrapper. Basically, somewhere where you can put your money that's protected from any further taxes, including any tax on any interest or any capital gains tax. So now that we know a brief history of the ISA, let's take a look at the different types of ISAs available as of May 2021. So currently there are 5 different types of ISAs. There's a cash ISA, there's a lifetime ISA, there's an innovative finance ISA, a junior ISA, and a stocks and shares ISA. A cash ISA is a completely risk-free savings account. Any interest accrued inside this account will not be subject to any tax whatsoever. And there are a couple of variations of this ISA. So firstly, there's an easy access account. In an easy access account, you can withdraw money from the account at any point and not pay any penalties. And then there's a notice cash ISA. So with this account, you will need to give a few days notice prior to getting access to your money. The benefit being that you're usually offered a higher interest rate than a standard cash ISA. To be fair, these don't appear to be very popular. A quick search led me to which.co.uk, with 3 providers offering between 0.3% up to 0.45%, and a notice period of 30 days. So generally, a fixed rate cash ISA offers a higher rate than an easy access or a notice ISA, but your money will be locked away for a set period of time. Though if you do need to access this money any earlier than that, you're going to pay a penalty for withdrawing it earlier. Cash ISAs, in my opinion, are a bit pointless. You could leave your emergency fund in them if you wanted to, but truthfully, you're going to earn so little in interest, it's not really worth keeping it in there to use up your tax allowance. Even if you are able to max out your £20,000 annual allowance, the interest you're going to earn in this account will probably be around £60 to £80 for the year. So that leads me to the Lifetime ISA, or the LISA. So this account helps you save for retirement or for a deposit to purchase your first home. This is done by giving you a 25% boost, which is currently set at a maximum of £1,000 of completely free money every single year that you can take advantage of. You're going to need to be between the ages of 18 and 39 to open up a LISA. And the current annual limit for deposits with the LISA is £4,000 a year. And this can be spread out throughout the year or deposited in one lump sum. So if you maxed out your LISA, you can have £5,000 a year, including the bonus, towards a house deposit or for retirement. The key point to note with a LISA though is if you withdraw this money for anything other than purchasing your first home or before you're the age of 60, the government are going to snatch back their bonus and you're going to be back at square one. So I think the biggest consideration with this account is access. You need to make sure you don't have any money tied up in this account that you may need for something other than its current purpose. So there are two types of LISAs. Firstly, there's a cash LISA. This may be the better choice if you're saving for your first home and you're planning to buy within the next couple of years, as you're going to know exactly how much money you're going to have in there and there's going to be no risk to your savings whatsoever. And then there's a stocks and shares LISA, and as the name suggests, you can invest the pot of money within the stock market. Now when investing in the stock market, you need to remember that it's all about the long game. So this account would more than likely suit you if you're utilising the LISA for retirement as opposed to a house deposit. The last thing you're going to want is your investments to dip just before you need the funds to buy a house. You need to think just like any other investment, long term. The exception that I can see here though is that if you intend on purchasing a house in the distant future, more than 5 to 10 years away, it's going to allow more time for your investment to grow within this account. And then we have the black sheep of the individual savings account family, the Innovative Finance ISA. This is another ISA that allows you to invest, however, it's a little bit different to the rest. When you invest in an Innovative Finance ISA or IFSA, FASA? I have no idea how you say that. Anyway, the company or platform offering this ISA will use your money to lend to borrowers or to businesses, and this is known as peer-to-peer lending. The idea with peer-to-peer lending is that you, the lender, hopefully earn money in the form of interest, which is a portion of the interest rate that the borrower is charged. So you're not going to get all of the interest because the platform or the company that actually does this for you is going to want to take their cut. But because you're utilising your ISA allowance, you won't be taxed on any interest earned. So my issue with the Innovative Finance ISA is that you're loaning money to businesses. And when you do that, some businesses aren't going to succeed. Therefore, they're not going to be able to pay you back, which means there's inherent risk with this method of investing. So just like an index fund, some platforms may spread the risk by spreading the money across multiple businesses. However, the majority of businesses that are going to utilize this type of investing, peer-to-peer lending, are going to be startups, making it a very high risk investment. And another downside for me is the accessibility of the invested money. So it could take months to withdraw your cash if you need or want it. And finally, your money will not be protected by the Financial Services Compensation Scheme, or the FCCS. So this is the scheme that protects your money up to £85,000 in a normal major bank. So then we have a junior ISA. So if you have young children, then you're going to want to consider opening a junior ISA for them. There are two types of junior ISA, a cash junior ISA and a stocks and shares junior ISA. I'm sure you're getting the picture based on the other products available, but you can have both accounts open should you wish at the same time. The current annual tax-free allowance is £9,000 a year, and that can be split between both. So I have a junior stocks and shares ISA for my daughter, and I utilise cost averaging into this account every single month for her. The beauty of this account is that it forces you to leave money in that account until your child is 18, where it will then be handed over ownership to them. And if you start young, this is plenty of time for money to compound, hopefully leaving your child with a healthy sum of money that they can use to purchase a first car or a deposit on their house. Which leads me to the account that I believe absolutely everybody should have, a stocks and shares ISA. Now, this account is something that prior to learning about personal finance, I knew nothing about. And I really do feel like it's just not talked about enough outside of financial circles. It's not even mainstream, and I don't know why. So with the stocks and shares ISA, you can utilise your ISA allowance of £20,000 a year to invest within the stock market. Now, it's important to remind you that when you invest, your capital is at risk. This means that the value of your investment can go up as well as down. Never invest in anything you do not understand, and you need to do your research. If you want some help getting started, check out the video that I did about getting started with investing that I'll link above. So money invested within a stocks and shares ISA, just like the Innovative Finance ISA, will not be protected under the FCCS scheme. This account should be used to invest money that you don't need access to for at least 5 to 10 years. This account should be used for financial freedom or retirement or whatever goal you have for your future self. You're going to need to choose a platform that suits you, so there's plenty to choose from, but I use Vanguard. If you'd like to see the process of how to set up an account with Vanguard, follow the link above that I made for an earlier video about how to do this. I've got no affiliation with Vanguard whatsoever, I just really like what they do and how they do it. So there are some fees and charges associated with the stocks and shares ISA that you're going to need to bear in mind. So firstly, there's a platform fee. Now, this can be a flat fee, which is probably best if you're investing large sums of money or some platforms charge a percentage of the value of your funds, which is great at the start, but as the value of your investment increases, it's going to become more costly. So some platforms like Vanguard have this capped, so once your pot reaches a certain value, you're not going to pay any more platform fees. Then there's potentially an annual management charge. Now this is the charge by the actual manager of the fund held within your stocks and shares ISA. This is always a percentage and can typically vary from 0.1% to 1% plus per fund. Then you need to think about trading fees. So this is the cost every time you buy or sell shares or funds. Now these can range from £0 to £25. So if you're an active trader, looking for low trading charge is going to be a high priority for you. Now I don't personally do that myself, I like to buy and hold. Now some platforms offer zero trading fees. The platform I like to use for this is Free Trade. So if you want to get set up with an account with them and earn yourself and me a free share worth up to £200 at the same time, follow the link in my description of this video. So then there might be a transfer out fee. So this will be the cost involved with moving your stocks and shares ISA from one platform or provider to another. And this can range from around £25 to £50, but not all platforms charge this. So make sure you read the small print before you make any swaps. And that's all the ISAs that are currently on offer at the moment. Personally, I think once you have a good financial foundation, and by that I mean you have no debt other than your mortgage and you have 3 to 6 months worth of an emergency fund sitting in the bank, then you should start with a stocks and shares ISA. I would then use the LISA to take advantage of the 25% bonus, and if you have kids, a junior stocks and shares ISA is a no-brainer. So I don't have a cash ISA and I just don't see why anyone would ever really need one, to be honest. And I don't really like the risk associated with the innovative finance ISA, so I can't really see myself getting that either. So if you have any comments or questions, please leave them in the comments section below and let me know your experience with any of these ISAs or your current strategy at the moment. And please remember, if you found this video useful, hit the like button and make sure you subscribe to the channel.